All right. So, um, the reason why I wanted to go over price strategies a little bit, and this isn't going to be, groundbreaking information here, but we are still experiencing, a bit of a sluggish market. The rates are kind of sticky, and that causes, these listings to sit on the market a little longer than it typically would. So, pricing the properties correctly and having the conversations with your homeowners about pricing properties correctly from the get-go and not, trying to test the market too much with high prices and things like that. So we'll go over a little bit of data here on, pricing the homes. And, what I did is I researched and broke down into different brackets, different types of home, different price points, which I thought would be a lot helpful depending on what type of listing that you have, because you don't treat them all the same across the board. It depends on the audience that you're marketing it to and what they typically look for. So we're gonna jump right into that. And yep, in the chat, Roxanne's email is info@riserealtyca.com. So, all right. So pricing homes for quick sale and maximum net profit. So I am starting to see some homes that were listed by us in late 2025 that are beginning to come back on the market. The sellers are giving it a second chance. Maybe it wasn't going that well at the end of 2025, and I'm starting to see that they have some activity actually. So, it is, you know, somewhat picking up a little bit, but in general, we all know that the market is still kind of sluggish. So let's break this down a little bit. So analyze comparable sales and current competition. For me, that's one of the biggest things when I'm comping a house is, I always want to look at what the competition is doing in the neighborhood. How many, active listings are there? How many pending sales are there? Yes, I look at the sales, the solds. I pull up the last 90 days. I don't usually go past that unless I'm just having a real hard time finding a comp. But I like to see the right now stuff. I want to see the pending listings. Where were they listed? Did they have price reductions? Or were they priced competitively and, went into escrow fairly quickly within a week or so? So I want to look at that kind of stuff. I want to see how many pendings there are. If there's not a lot and there's a lot of active listings, then that's going to be an indicator for me that the market in that particular little pocket right there is probably a little slow. Now, if I see a fair amount of pending listings and equal or less active listings, then it looks like stuff is moving along in that market. So, I don't have to be as sensitive with the pricing, I guess if you want to put it that way. In the slower neighborhoods, we don't want to really be pricing with the other people that are just sitting there, especially if your seller has a high motivation to sell. So, we want to use the recent sales activity, like I said, usually 90 days or less, as the foundation of the pricing. And so this is going to be about pricing more than comping a house. We're not really talking about that as much here. So we're talking about pricing strategy. So we want to review pending and active sales to understand the real-time market conditions and buyer demand. Pay attention to price ranges that have shortest and longest days on market and adjust accordingly. I also like to call the pending sales and the active listings. I like to call the agent and just see how it's going for them, especially on the active ones. Are they getting a lot of action? You know, have they had offers on it? What's going on? And then with the pending sales, yeah, I mean, I'll ask them, did they get close to list price? You'd be surprised, a lot of realtors are willing to have a conversation with you. And why do I want to know that? Because I want to know, if that last price they were listed at, solicited an offer from a buyer that was, similar to the list price or better or worse. So, because that's going to help me with my pricing of my similar listing. Um, you can use multiple valuation methods besides the sales comparisons. Consider price per square foot. and current rate of appreciation or in declining market. Which way is the market heading? What's the trend? To establish a price range. Combining the methods helps you cross-check your number and build confidence with you're presenting to the clients. Now, I know a lot of people say price per square foot, means nothing. Appraisers don't use it, all that kind of stuff. I tend to disbelieve that. It kind of depends on the neighborhood I'm looking at. If I'm looking at some, pretty some neighborhoods where it's tract housing, a lot of conformity, that is an area for me where a price per square foot, I'm not going to rely solely on it, but I do look at that and I look to see if there's similarities in the neighborhood because that will let me know if my price is going to be, kind of in the ballpark or not. I also believe that in condos, that it's a pretty good indicator as well. Now I know there's going to be adjustments for views and floors and things like that, but in general, condos are pretty easy to price out because they're all pretty similar. It depends on the community, I guess, but most of them are going to be within a certain range of the others that have sold. Previewing homes across price segments, it's good to go out and see what the competition is. Even if you don't have a listing, it is good. If something's along your way, check it out, see what's on the market. It's always good to know what's going on in the area that you're farming and wanting to work. That helps a lot with conversations that you have, especially spur of the moment conversations. But it's also good for research because you can really see kind of what trends are happening when you're getting into these homes. And you can see, okay, well, this one's fully remodeled and they're asking this over here. And a couple weeks ago, I saw one down the street and, it was, it needed updating and that one was priced over there. So you start to really get a good gauge of the market, and that'll help you with pricing. Factor in the seller's timeline. This is another big one for me. Um, how quickly does my seller need to move? What is their motivation? Um, does that affect the value of the house? No, but motivation is going to help you price this correctly and also service your client the best as well. Because if they have another home in escrow or they're relocating and have another home in escrow or they need to be, in that new city or whatever by a certain timeline, then we need to price the home accordingly so that we can meet their timeline. Um, this is a big one, and I think it still accounts, even today, we're seeing natural language home search come into a lot of search party portals that, the Zillows and whatnot. Other websites are getting it too. The natural language home search is, I want a home under 800K in this certain city with these certain features. Someone types that whole thing in rather than scrolling through the little filters and figuring that out and trying to add in a keyword or something. There is a shift to natural language search, which is actually how everybody's starting to search anyways now. They're spelling out their whole problem on Google, and then hopefully they're getting an AI answer. And it's the same principle with the home search portals. So you'll find, and I'm sure we all do it too, we say, they use pricing brackets, 750K to 1 million, pricing at or below such a tier, such as 999 instead of the million, ensures the home appears in more searches and leverages the left digit effect, which is a psychological basis where buyers perceive 999,000 as closer to 900K than it is to a million, although even though it's not, I mean, this is why when you go to the store, that's the way everything looks, and that's because it works, and it's no different in real estate. But it does depend a little bit on your price point of your home, which we're going to cover here shortly. Manage the first weeks on market. This is when you get the most traffic. It's the biggest opportunity to get that home sold is the first couple weeks on the market. You're going to get the most views, the most likes, the most saves, the most visits, all that stuff in the first week. So pricing in properly that first week will greatly increase the buyer pool for the home and the chances for receiving the offer. And this is the kind of stuff we want to have the conversation with the seller. And I like to ask them, how much do you want for the house? What are you looking to get? And then I want to see how far our expectations are from each other, what their expectation is and what the reality is. And sometimes they're pretty close. And that's going to determine the kind of conversation I'm going to have with them about pricing it correctly from the beginning, especially when we're in this, sluggish market. Um, Adjust strategy for the market segment. So pricing luxury properties differs from pricing entry level or mid-range homes. Each category has distinct buyer expectations and competitive landscapes. Um, and then use psychology thoughtfully. Behavioral studies show that odd pricing, or they call it charm pricing, influences perception. So ending a price in nine or another non-zero digit makes the price feel lower due to the left digit effect. In luxury markets, however, round numbers such as just a flat 10 million may signal prestige and confidence. So you want to tailor the pricing to your target buyer's mindset. So let's look at these different segments here. Entry level homes, your first time buyer homes. Um, these are ones that you don't want to go with, the flat 0 pricing. So many search by the tiers, such as, even if they're using natural language search on the third-party search portals, they might say, show me all the homes with 3 bedrooms under 500K in this particular city. So if you're priced on that cusp, of 505 or 510 or something like that, it could uh, diminish the amount of eyes that are going to get on that listing. That's an odd price point. You would, in most cases, be better to price it at 499 versus 500K, uh, because you will get more buyer eyes on that, and they will realize, oh, well, this one was only 505 or 510. I can stretch that, so I'm going to go take a look at this place. So price at or slightly below market value to attract the widest buyer pool and trigger multiple offers. Yes, we still see multiple offers. Um, I was writing some offers with some agents this past week, and both properties, they were up in the LA area. Both of them had multiple offers on them. Both of them were entry level homes. So when you price them correctly, you still will get the multiple offers. So a study of pricing pyramids show that pricing a home at market value attracts about 60 to 70% of the potential buyers, while pricing 10% below market can increase the buyer pool to 75 to 90. Now 10% is quite a bit. You might want to look at maybe 5% or 10% depending on your price point here. But pricing it, just under market value is going to get you a lot more eyes on it. For a turnkey entry level home, slight underpricing may lead to the bidding war that you're looking for and net a higher final price. So you want to avoid pricing more than 5% above in current market conditions, because this can cut the buyer pool in half. Even just 5% could cut that in half. They're going to look at it as overpriced. We looked at that stuff last week with the listing hygiene. So especially if they're looking at Zillow and the Zestimate is showing on there, and this listing price is showing you know anything above what the Zestimate is, essentially, it doesn't look like a deal. Um, and then psychological pricing. So we want to end this in a 499 or something like that rather than the flat 500. Psychologically, it seems like a better price point for that segment of buyers. Mid-range homes, pretty much the same. So it's going to be, usually your move-up buyers. These are move-up families, professionals, comparing multiple neighborhoods and features. They're going to be a little bit more picky about the neighborhood in certain features because they've they're leaving the first-time buyer house and learned what they do want in a house, so they're a little more finicky typically. Um, Use a narrow pricing band around the market value. Leverage recent comparables. Again, don't go back past the 90 days, just for condition upgrades, so on and so forth. We got to look at the pools. We got to look at the quality of, the upgrades that were put in there. Um, Price slightly above similar homes, but remain within the search bracket. So it could be better, at 1.249 versus 1.25, could be better in this scenario, for this type of price point and this type of segment of buyer. When we're looking at luxury homes, now we're getting into something different. So high net worth individuals seeking exclusivity, privacy, and exceptional quality. They are often less price sensitive, but value prestige. So the strategy there, if you have luxury listings, um, so typical higher end agents consider comparables in local and comparable national markets, property conditions, seller motivation, and unique amenities, because you will find that in luxury properties. They remove emotion from the sellers and counsel realistic pricing to elicit offers. Use narratives and storytelling to justify value and highlight scarcity in ultra luxury segments, dynamic pricing models, um, track buyer engagement and adjust by small increments, 1 to 3%. So you're not going to see these huge drops, as that maintains buyer interest without signaling distress. So that's not something that you want to stigmatize, essentially that home with, if you're in the luxury market, or if you happen to have one pop up. Psychological pricing, premium brands. You'll notice, if you're out there shopping in the mall or something, the premium stuff. They often avoid odd pricing. Buyers associate round numbers with prestige. For example, pricing at 10 million versus 9.99 million may convey confidence. However, subtle price brackets still matter. Pricing at 9.995 may appeal to international buyers searching under 10 million. So you have to know, what this home, what type of buyer is this home gonna, attract. So you want to caution aggressive discounts. They can erode buyer trust and damage brand perception. Price reduction should be strategic and minimal. Condos, townhomes, I kind of went over that already. You take into account the floor it's on, the view, you know, is there an elevator to the upper floors? Is it all stairs? These are things that are going to whittle down the buyer pool. Um, And yeah, I do kind of like the price per square foot to see what the range is in here. Um, Another thing to take into account right now is with the balconies and if this condo is actually going to qualify for financing, because I had a listing in Anaheim earlier this year, and they were also listing one in Westminster. Very, very similar condo communities. Really nice grounds. They had little rivers flowing through them and stuff. And price points, we started right about the same, right at about 500K. And one sold the first week, and that one had a a manageable HOA fee. It was I think three and a quarter over there or something like that. The other one, HOA, was in the 600s, and it just it wasn't selling. It had to keep going with price drops, and they were like, well, they're the same thing, both these units are same bedroom count, they're about square footage, the upgrades on the inside are about the same, but that HOA fee was just really pricing out a ton of buyers. And then I'm seeing other ones that can't get financed because they haven't come into compliance with their balconies. And so we're having a hard time getting those things financed. And so the buyer pool on them is so slim that, these really need to be priced aggressively. Fixer-upper, distressed homes, um, investors and DIY buyers who factor renovation costs and profit margins into their offers. Strategy would be, start with the market value of the comparable move-in ready home. So let's imagine this home as move-in ready, and then deduct the estimated costs of repairs, and then also a contingency margin, 10 to 15%. You can go 5 to 10% depending on your price point. Um, and then subtract an investor profit margin. Usually you're looking 10 to 20%. That'd be on the slim side. So if you think this is going to sell to a flipper, then you want to factor in these costs. And what I found with them too is you don't want to go in and say, hey, look, seller, this home needs a ton of work. This is bad, that's bad, this doesn't look good. We need to redo all this. And have them price out the home with you. Have them price out the the cost of repairs. Well, we can both agree here that the kitchen needs to be remodeled, full remodel. How much do you think that that's going to cost you in this house? And let them tell you about what they think it would cost to get that done, and do that in the high cost areas. What's a roof cost these days? What's this foundation work going to cost? Bathrooms, kitchens, the high price stuff. And then that way there, they can reason it a little bit better as you've gone through the home, and let them tell you how much all this stuff is going to cost to bring up to par for the comps that they're looking at and they're trying to price their home with. And it's a little easier to reason with them than when you say, well, you just told me that this home needs $60,000 worth of remodeling. So we need to be pricing this at minimum $60,000 less than the home down the street that was fully remodeled that you're, using as a comp in your head. So it's a good strategy when you're dealing with the fixer-upper segment of the homes. Rural agriculture properties. These are so unique. You know, you want to factor in land size, water rights, how many outbuildings are there, barns and things like that. Zoning, proximity to services, does it have a well? What, all this stuff has to be taken into account. And so getting the comps can be definitely challenging. But those kinds of factors can help with the price as well, because some of that stuff is expensive to put in. The infrastructure is expensive, and so again, you want to value some of that stuff individually as you're comping this property out, as well as what's going to be conveying, with the sale. Um, so psychological pricing on this, buyers may focus on land value per acre rather than the total price. Transparent pricing with emphasis on land value and potential uses help builds trust. So you want to tell that story of all the infrastructure, or maybe there isn't infrastructure in the land, with your pricing strategy. The charm pricing, we'll run through that real quick just for sake of time. Ending in 999, other than non-zero, and other non-zero digits, leverage the left digit effect, meaning buyers disproportionately focus on the first number and perceive 299 as closer to 2 than 3. Major retailers do this over and over and over again, obviously for a reason. Um, so think about that when you are doing the pricing, especially if it's on what could be a bracket for that price point of home. Meaning, are you at the 500K, or at the 550, are you at the 6? These are price points where people use the filters, or they just say, find me something under this price, because we want to make sure that we're falling into that category. Um, the pricing mistakes, overpricing, this is a death sentence for most houses. This would cause your listing to sit. This is probably something you really want to talk about a lot in your listing appointment. Starting too high leads to the fewer showings, less online engagement, and longer market times. It eventually results in price reductions and perception that something is wrong with the property. Even going 5% over can cut the buyer pool in half. Buyers may ignore overpriced homes because of the search filters. exclude them, and comparables make them look inferior. So again, depending on, the segment of home this is, we don't want to overprice the homes in this type of market, which, you know, is what we've been in and what we're going to continue to be in, for a little bit longer. So underpricing without a plan. So, maybe the seller's like, hey, I need this thing out of here. Just get it sold. This is my minimum. You know, you want to still have a plan. You just don't want to throw out this price, this too good to be true price. So you want to be intentional with everything you do, and you want to create the bidding war. You want to drive up the final price. But if the demand is weaker than expected, the seller may lose leverage and fail to reach target pricing. So if you're pricing it under, but maybe not quite enough, or if it's in an area that really just has slow sales, not a lot of turnover, maybe it's a rural area, maybe it's a really small town where there's not a lot of buyer pool, you know, that might not be the best route. So, definitely take into consideration, who the audience is for the house. Failing to adjust to market shifts. A few years ago, this was definitely a thing, and we saw more cancellations, when the rates started climbing, than really I've seen in a long, long time. It's been, fairly stable. I'm sure we're all, seeing that the prices aren't moving around a whole lot right now. Um, but watching the rates, and that's why we talk about the rates in the mornings, so we can see, which way these rates are headed, because a lot of times new mortgage applications and sales are kind of trailing right behind that number. So if you see these creeping up, the market's probably slowing down just a touch. And so you want to, relay that kind of information to the seller that, hey, some buyers might be pulling back right now because the rates are going up. So we should, look at our pricing strategy or look at our current price and see if we need to make some adjustments before, it gets too late. And then ignoring seller motivation, always take that into factor. I always want to see, what does the seller need? What's the motivation for getting this thing sold? Um, and then, price it accordingly. So I'm gonna go down to the refrigerator war scenario. And I'd be curious on the pricing. Do you guys have any tips and tricks you want to share in the chat? Definitely throw them in. We got a lot of people on these meetings with a lot of experience. So I'd love to hear what you have to say as well about your pricing strategies, especially in current market conditions. So we had this come up. This comes up all the time. Probably every couple of weeks, I get this call, right, about well, it was in MLS, but I didn't put it in the offer, right? So I saw this little article come out from Car Legal, so I thought I would share, kind of most of it, because it's kind of a somewhat funny scenario for me because I hear it so often, both sides, whether we're on the buyer side or the listing side here. So one of the most frequently asked questions to car legal involves a scenario that comes up so often that they nicknamed it the refrigerator war scenario. So this scenario almost always involves a buyer and seller who believe they're entitled to the refrigerator due to a discrepancy between the items listed as included with the sale in the MLS listing and the items listed as included in the residential purchase agreement. In the scenario, the MLS listing states a refrigerator will be included with the sale, but the buyer's agent forgets to check the refrigerator box in the RPA section 3P1. So the P section is where you tick off all the stuff that you want to convey with the house. And so that looks like this section here. And you can notice that the only thing that's checked box is the bathroom mirrors, and that's because it's checked box by default with the contract. So if you don't check anything in here, you're saying, hey, seller, we don't want any of this stuff to convey. Please take it with you. So after the parties open escrow, the seller says she's going to take the refrigerator out of the property per the RPA. The buyer's agent, suddenly realizing the mistake, panics, calls the legal hotline, Says I made a mistake on the RPA. I was rushing when I wrote it, whatever excuse. But the MLS listing said the refrigerator would be included, so the seller can't take it, right? And unfortunately, that is incorrect. So the refrigerator would be excluded. It's not in the actual purchase agreement. So just remember what you see in the MLS is non-binding. So just because it's advertised in there, if you're not asking for it, it's not going to convey. So, well, what part of the RPA states this? And it's actually in paragraph 9, and it says items listed as included or excluded in the multiple listing service, flyers, marketing materials, or disclosures are not included in the purchase price or excluded from the sale unless specified in this paragraph or paragraph 3P or as otherwise agreed. So they're saying that it doesn't matter what you saw advertised, if you don't ask for it, it's not conveying. And this is pre-printed in the RPA right here. I had this other iteration come across last month, and it's actually the first time I've had this question come up, and I thought it was pretty comical. Um, but let's go over this real quick. So the other iteration is um, when an agent calls the legal hotline and says the MLS did not list a refrigerator as being included, but the buyer's agent checked the refrigerator's box in RPA 3P1. The buyer's agent then calls the legal hotline and asks the car attorney, the house doesn't have a refrigerator in it at the moment, but the seller had to go out and buy a refrigerator for my buyer, right? And that would be incorrect. So the RPA, paragraph 9B2, says that all items specified as included in paragraph 3P are included in the sale only if currently existing at the time of acceptance. And what they mean right there is existing in the home, not existing on Earth, not existing at Lowe's. It's existing in the home at time of acceptance. So the call that we had gotten, we were on the listing side and we had an outside buyer's agent, and that buyer's agent had checked off a bunch of stuff in here on the RPA, all in the P section. They wanted, all this electronic stuff and the washer and dryer, and they were fully under the impression that all of that stuff was going to come with the home because they included it on the RPA, even though the home didn't have this stuff. And it kind of threw me for a loop a little bit because I haven't actually come across that question in particular. The other one, yes, all the time. But you will see um, the RPA 9B2 states all items specified as included 3P are included if currently existing time of acceptance. And here it is right here, 3B or 9B2. It's in bold even right here. So again, that doesn't work either. You can't toss in a new car or the car that's in the garage or something like that. Like if there's no car there or being, it's not how it works. So it has to be at the house, in the house, at time you're making the offer. And that is the stuff that essentially you can ask for. Um, but if it's not in the house, then you can't ask for something that's not there and then expect them to come and buy it. Um, so in short, when filling out an offer, RPA for your clients, don't rush, slow down, look at the MLS, ask the buyers what they want what do you want to convey? Do you want all this stuff? And put that in the P section there then. So just don't rush through and then don't skip the P section because that's all the stuff that the buyer really is expecting to convey with the house. And so if you leave that blank and they're under the impression that they're going to get that stuff, or if you told them, well, it's an MLS, so it's going to convey, you're probably going to find yourself buying some appliances. Couple questions. Yeah, that's funny, Rena. So, yeah, we had Tracy piping in there on pricing. She's been taking a ton of listings. Um, so wrapping up here, what do we need to know about the California Invasion of Privacy Act? So no, this is not the CCPA document at the end of your, listing bundle or purchase bundle when you're in zip forms. This is something different. And I found this interesting that it has gained enough momentum, I guess, as far as calls coming in to Carlegal and other places that they put out a notice on it. And I saw something about this end of last year in a Facebook group I was in for Sierra Interactive, actually. And someone had brought it up about being contacted by one of these attorneys having to do with the cookies on their website. So if you have a website and you have a tracking link or anything like that where you are gathering IP addresses and information, this is what this is pertaining to now, or at least what these attorneys out here that are trying to drum up business essentially are trying to say. So this is how it goes. So in the last few years, an almost 60-year-old law firm has resurfaced to haunt website owners. Originally acted in 1967, the California Invasion of Privacy Act was meant to address actions such as wiretapping and use of other techniques to eavesdrop on private telephonic communications. Among other things, the law prohibits the use of pen register or trap and trace device, both of which are surveillance tools without a judicial order or consent from the person being tracked. So fast forward to now, 2020s, and here's what we're seeing. The plaintiffs have gotten creative about applying CIPA to modern technologies that weren't even contemplated when the law was enacted, particularly commonly used website tracking tools that allow businesses to track the activity of website visitors and gather information about visitor behavior that may be useful for analytics, advertising, and other purposes. So here's the gist of the claim. Use of website tracking technology such as cookies, pixels, and if you're doing any Facebook advertising or anything like that, you can install that Facebook pixel onto your website so that you can help Facebook find the audience a little bit better. This is the post that I saw in the Facebook group. They were talking about the Facebook pixel in particular. Tags and beacons constitutes the use of a pen register or trap and trace device to record a user's interactions with the website. And deploying such technology without first obtaining consent from the website visitor constitutes an invasion of privacy under SEPA. So this is what they're claiming. So SEPA allows for a broad private right of action, and the civil penalty is greater than $5,000 per violation, or 3 times the amount of actual damages, and there's no safe harbor provision. As such, there has been a proliferation of legal demands, many from opportunistic plaintiffs who scan websites to identify potential violations sent to the businesses, both large and small, alleging SEPA violations. In some instances, these threats have proceeded to litigation, including class actions, with mixed and sometimes conflicting results. As of the publication they put out, the Car Legal, no claim has yet been fully litigated to a final judgment on merits. So this is like stuff that's coming around right now. So what is the California Invasion of Privacy Act? It's a criminal statute initially enacted 1967, expanded to various amendments through the years. The purpose is to protect people's privacy. One of the requirements of SEPA is that a judicial order or consent of a user of an electronic or wired communication service is needed before the person can use a device or process. Previously, these types of devices related to telephone communications that recorded, transmitted electronic information. Recently, however, courts have interpreted current technology such as cookies and trackers, which allow businesses to track the website use of visitors and gather analytics as falling within SEPA's definition of pen registers and trap and trace devices. So what does it matter to us? Well, a lot of us have websites. A lot of us are trying to drive traffic to our websites by running Google pay-per-click ads, Facebook, Instagram ads, things like that. And to do those successfully, typically you're adding in some sort of tracking, like the Facebook pixel or something like that. Um, so it looks like there's conversation going on. So um, last couple years, there's been a surge in legal demands, litigation applying SEPA to website tracking technology. Many realtors have websites for their businesses, might use cookies or trackers, for example, through services such as Google and others like Facebook Pixel, to gauge various website metrics. These cookies or trackers typically allow the website owner to ascertain how many people visit the website, when they visit the website, what pages they're visiting, and other activities that visitors might engage with while on the website. In addition, these cookies or trackers may collect information from visitors like IP addresses, email addresses, browser settings, metadata, operating systems, geolocation, a whole slew of things, right? The use of cookies and trackers to obtain these kinds of information may subject realtors to SEPA requirements and correspondingly to opportunistic lawsuits alleging SEPA violations. So, how can realtors use cookies and trackers on your websites while complying with SEPA? This is a fairly easy part here. They just want to make sure that you're doing. So SEPA allows websites with cookies or trackers to collect information such as IP addresses, browser settings, and other information website owners may need to track website use or obtain advertising analytics if they have obtained user consent, only use the cookies or trackers to operate, maintain, and test a website, protect the rights or property of the website owner, protect the website users from abuse of the website or unlawful use of the website, or record the fact that the cookies or trackers are used to protect from fraudulent, unlawful, or abusive use of the website. Or number three, have a court order to place cookies or trackers, which I'm sure none of us have. So we're looking at number one here, making sure that you have some sort of pop-up, and I'm sure you see them all the time. You go to visit a website, there's a little pop-up that talks about this website uses cookies and things like that, and make sure it's correct. And then usually the consumer has to check a box, and then the little pop-up goes away. Basically, that's them giving consent, yes or no. And then that'll at least protect you on that front. Um, Practically speaking, most businesses will likely not be able to obtain a court order. Additionally, cookies and trackers are typically used for advertising and performance analytics, not for the purposes listed in section 2 above. As such, the only way most businesses can comply with SEPA is to obtain consent from their website visitors. What does that look like? What is the consent? It involves a visitor receiving a notice of the placement of cookies and trackers on the website and agreeing to their use to collect and share, if applicable, information. Most importantly, courts have held that having a terms of use and privacy policy on a website is not by itself sufficient to constitute consent. The notice must be reasonably conspicuous. So, for those of you that do a lot of web work on your sites, if you have that privacy policy on there somewhere, even if it's, buried down in the navigation menu somewhere, that's not enough. We need it to be, a pop-up is probably going to be your best choice here. For example, can't be small print. It must use font colors that do not blend with the background, and it cannot be hidden somewhere on the website. The notice may also include a link for a more comprehensive notice that explains what information is collected and how the information will be used or shared. So, if you don't want to put up this whole disclaimer about the cookies, you can link it over to a page where you have all of that information. Example, again, pop-up banner. provides short notice stating that the website uses cookies, links to a more comprehensive notice that allows visitors to consent to the use of cookies and trackers. That may apply with SEPA. So if you're seeking a website out there from any one of the numerous companies that do website development, ask them about this, the cookies consent. Do they have a pop-up? How is that positioned on the website? So that you can protect yourself from these, you know, attorneys out there looking to drum up business essentially. As always, it's recommended to consult with legal counsel for how to obtain the consent for the website visitors. You know, it's always good to be proactive with this stuff. So I just wanted to share that information because I did see someone ask questions about that in a Facebook group. They were pertaining, they were asking about the Facebook Pixel, and they said that they had been contacted by an attorney looking to kind of, stir it up with them a little bit. So if you have a website, if you're thinking about getting a website, make sure you're in compliance with this, as this is just another one of the things that we're, fending off as entrepreneurs and business owners. Um, Unfortunately, it's just the business environment that we live in these days. So, yes, Raina, that is true. So, um, all right. Well, that's it for today. Ended right on time. Perfect. So, if you have any questions, if you need anything, we're always around. And next week, I believe, is Memorial. So, we're not going to have a meeting next week. We'll send out a notice for having a bye week, but we'll still be around working. So, if you need anything again, give us a call, reach out, and hopefully everybody has a great week. And we'll see you in 2 weeks. Talk to you later. Bye.